If you own a business, you know the hustle. Maybe you're pulling in $3 million in revenue. Maybe you're hitting $30 million.
Right.
And for most of you, this company, it's not just a paycheck. It is the single largest, most important financial asset you have.
It's the engine.
It's the engine driving your family toward that, that 8 or 9 figure net worth you've been working toward for 20 years.
It should be the ultimate asset. I mean, decades of sacrifice, growth, stress, all leading to one critical moment.
The liquidity event.
Exactly. The moment where you finally step away with generational wealth.
But here's the thing. Here is the silent crisis, the jaw-dropping statistic that serves as our wake-up call today. 4 out of every 5 businesses that go to market that are listed for sale, they never transact.
80%. It's a brutal failure rate. And you have to stop and think about the human implication there.
Absolutely.
We are talking about owners. I mean, people listening right now who have poured 20, maybe 30 years of their lives, their identity, into a company. They finally get to a point where they're tired, they're ready for what's next, and they put their asset up for sale, only to find out the market sees it as worthless.
And that failure to exit successfully, walking away with nothing, or maybe just a fire sale price that doesn't even fund retirement, that is a profound financial crisis hiding in plain sight.
It is.
So today we are going to unpack exactly why this happens. And the answer is, well, it's simple, but it's incredibly painful. Most owners confuse building a job with building an asset.
That distinction, job versus asset, that is the brutal truth we need to confront right now.
Okay, so let's get into it.
When we cite that 80% failure rate, we're not talking about owners who just didn't get their dream price. We're talking about the businesses that couldn't even find a buyer who saw tangible, transferable value.
And when you look at the other side, the success side, the numbers are just as sobering.
They really are.
Only about 5 to 10% of owners successfully pull off a third-party exit for a real gain.
And even trying to pass it on to family, that's tough. It happens in less than 20% of cases. The odds are just fundamentally stacked against the owner who isn't thinking about this stuff proactively.
It's the outcome of decades of work that most owners just don't see coming.
They don't. They build a wonderful lifestyle business, It provides a great salary, a sense of purpose, but they fail to build an exit vehicle.
So let's drill down right into that core flaw.
Yeah.
You're the owner. You're ready to retire. You want to sell. You've done all the right things, you think, to maximize revenue and profit.
Right. And the buyer comes in, they look at your P&L, and it's phenomenal. They see great EBITDA. But then they start asking the really important questions.
The due diligence questions.
The ones that matter. What happens if you, the owner, leave tomorrow? Wait, so the top 3 sales contracts are all based on your personal relationships from the golf course?
Does the entire operational workflow exist only in your head?
Exactly. And suddenly, that high-margin business becomes an immediate, massive liability. The owner is the sales engine, the strategic director, the chief problem solver.
The ultimate customer relationship manager. They realize the business is them.
The business IS them, and that lack of transferability kills the deal. The buyer realizes they aren't buying a self-sustaining asset.
Right, not a machine that can keep running.
No. They recognize they're just purchasing the right to take over the owner's extremely demanding 80-hour-a-week job. And they'll probably face a 50% drop in revenue in the first year because the owner just walked out the door.
That idea of transferability is the absolute difference maker. And it connects directly to the biggest tactical mistake we see, which is what you call the 3 to 5 years out trap.
Oh, this is the common piece of backward thinking we see every single day.
I can imagine.
Most owners treat exit planning like retirement planning, something you start thinking about when you are, 3 to 5 years away from your target date. The thinking is, I'll operate hard for 2 decades, and then I'll figure out how to sell.
But you can't. If you've been running the business as a job for 20 years, you can't just flip a switch and turn it into a self-managing asset in 3 years.
It's like deciding you want to run a marathon next month when you haven't run since high school. It forces them to scramble.
All right.
They try to retrofit an asset mindset, documenting systems, delegating key relationships onto a structure that was always designed to centralize everything around the owner.
And buyers can see that, right? They can smell the desperation of that last-minute effort.
Oh, absolutely. It screams instability. It significantly lowers the multiple they're willing to pay because the perceived risk is just massive. You're playing catch-up on the very systems that buyers use to calculate future predictability.
And that leads to the key insight here.
Right. Exit planning isn't about getting out. It's a fundamental business-building philosophy focused on building value and, crucially, reducing dependence from day one.
So if that's the big failure, what do the successful 20% do differently? What's the success philosophy?
They approach the business with an owner-investor mindset, not an operator mindset. They're thinking about the end goal constantly, not just when they get tired.
So they're asking the buyers questions, but they're asking them on day one.
Exactly. They're constantly pushing, asking, how do I make sure this business creates value without needing me every day? And what specific systems and teams would a sophisticated buyer look for to give me a premium multiple?
They're optimizing for eventual liquidity, not just for the maximum current salary or control.
And that's a key point. They understand that control is a massive valuation killer.
Okay, let's contrast those two approaches, because this is where listeners really need to identify where they sit. Let's start with the operator mindset, the vast majority.
The operator is the individual trapped in the weeds. They are the essential daily bottleneck. They're the person in the office answering emails at midnight because they have to approve everything.
You mentioned the personal relationships. Can you walk us through a specific example of why that operator mindset just tanks the value for a buyer?
Absolutely. Think about the operator who is also the company's best salesperson.
Very common.
Very. They manage the largest client, let's call them Client X, based on a 15-year relationship built on the golf course, personal favors, calls only they can make.
Right.
When the buyer does their diligence, they see $5 million in recurring revenue from Client X. But they realize they're not buying that revenue stream. They're buying a high-risk gamble that this client will stick around after the operator leaves.
So the buyer has to heavily discount that $5 million because there's no systemic protection for it. The operator built loyalty to themselves, not to the brand.
Precisely. Now, contrast that with the successful 20% the owner investor. Their entire approach is about making every component replaceable and efficient.
They don't just hope the new salesperson can replicate the owner's golf game. They systematize from day one. They build documented processes for everything.
Yes. Lead generation, account management, customer delight. They build a team that can execute without needing constant permission. They invest in systems that generate predictable outcomes.
They engineer optionality into every decision.
Optionality. Because the more options they have, the higher the value of the asset.
And the result is their business isn't a demanding job. It's a true asset. It generates cash flow predictably. It can run without the founder. And that's what a premium buyer is looking for.
They pay for predictability and scalability, not for the privilege of working themselves to death.
Which takes us right back to the money.
And this is so critical for our audience who are aiming for that 8 to 9 figure net worth. Your business is the primary vehicle to get you there. You have to treat it like one.
So let's look at the numbers, because this really illustrates the scale of the change that transferability unlocks. Say you're doing $3 million in revenue with 20% EBITDA. That's $600,000 in earnings. If you sell that classic owner-dependent operator business, you might get a 4x multiple, so $2.4 million exit. It's nice,
Right.
but it's probably not the generational wealth you worked 20 years for.
Not at all. Now let's scale it up. A mid-sized business doing $30 million in revenue with 30% EBITDA. That's $9 million in annual earnings.
Right.
If that business has strong transferability, documented systems, a solid management team, it's far less risky. A buyer, especially private equity, might pay a 6x or even 7x multiple.
So at 6x, you're looking at a $54 million exit.
That's the difference. That is the difference between a good payout and generational wealth. The crucial pivot point isn't just growing revenue, it's the multiple. And the multiple depends entirely on how transferable your business value is.
This is the biggest secret, I think, that most owners miss.
It is. Most owners focus on the tangibles: revenue, profit, inventory. But studies show that 70% or more of your business value, the part that drives the multiple from 4x to 8x, comes from intangible capital.
Okay, so buyers aren't just buying your P&L. They're buying a stable, documented operational machine. They are paying for a lack of risk.
They are purchasing your systems, your brand equity, the quality of the team that stays after you leave. And this transferability isn't accidental. It is specifically built through what we call the 8 intangible capitals.
Okay, so since this framework is the solution, let's go a little deeper. Give us a brief illustrative description of, say, 3 or 4 of these capitals so our listeners really get it.
Absolutely. Let's start with human capital. It's not just about how smart your employees are, it's about their capability to execute without you.
So a weak human capital would be the owner having the only password to a critical system.
Exactly. Or being the only person who knows how to fix the core problem. Strong human capital looks like a scalable training program, clear job descriptions, low reliance on any single person. The buyer wants to see that talent is retained by the system, not by the founder.
The system is the asset. Okay, what about something that sounds a little bureaucratic, like structural capital?
Structural capital is your governance. It sounds boring, but it's critical. It means having an advisory board, clear reporting structures, documented compliance,
All the unfun stuff.
all the unfun stuff that shows stability. If your board meets quarterly and has outside voices challenging leadership, that's a huge plus.
Yeah.
If the owner just makes decisions in a vacuum, the buyer sees a single point of failure.
And let's touch on one more because it's often the operator's biggest weakness.
Yeah.
Operating systems capital.
This is the documentation. It's the difference between a pizza shop that relies on the owner's memory for the secret sauce versus McDonald's, which has a 300-page manual for everything.
Right.
Operating systems capital is proof that your business can run on autopilot. It proves a buyer can take your successful processes to a new market without you. This is what turns tribal knowledge into transferable value.
So to bring this back to the money, a business with weak human, structural, and operating systems capital might sell at 3x EBITDA.
Right.
But a business where those are robust and documented could sell at 6x or 8x. That's double or triple the exit value for the same revenue.
That is why you cannot wait. The structural work has to begin now because these capitals are the engine of predictability, and predictability is what drives the multiple.
So this is the mindset shift you have to make today, whether you plan to sell next year or in 20 years. Stop thinking like an operator who runs the job.
And start thinking like an investor who owns the asset. And the easiest way to start is with a little self-assessment. Put on the buyer's hat right now.
Okay, so if you were investing $20 million of your own money to buy your business today, what would be your 3 biggest immediate worries?
Would you worry that the owner is the only person who knows how to deal with that major manufacturing issue?
Would you worry that your key $5 million customer is only loyal to you personally and that contract walks out the door with you?
Or would you worry that there are absolutely no documented systems for anything, for training new staff, for managing suppliers?
If the answer to any of those is yes, then you are still running a highly successful job, not a sellable asset. And the time to tackle this is today.
Because here's the empowering paradox of it all, the paradox of optionality we need to leave you with. The goal isn't just to sell next year. The goal is building maximum value and optionality today.
The more your business can run and scale and profit without you, the more valuable it becomes.
Right.
And the beautiful kicker is, the more valuable it becomes, the less you actually need to sell it, because it's generating passive income. You create freedom.
You create true wealth. You maintain ultimate control over your life and your timeline.
So, to summarize the core takeaways here, the 80% failure rate isn't a market anomaly.
No, it's the result of building a job, not an asset. Value creation starts today by relentlessly focusing on transferability, which is driven by these 8 intangible capitals.
So here's your assignment for the week.
Where
Well, it's one small piece of documentation, a simple standard operating procedure, a documented list of customer pain points. What can you tackle this week to prove that your business is slightly less dependent on you?
Start building the asset, not just the workload. And that foundational work is exactly what we'll dive into next time.
It is. In our next deep dive, we're breaking down the exit readiness framework that successful owners use.
We will detail each of those 8 intangible capitals, show you clear, real-world examples of what a strong score looks like versus a weak one.
And most importantly, we're going to give you a clear scorecard, a 1 to 5 scale that you can use to assess your business today.
This is how you start engineering that higher valuation multiple immediately. So join us for that tactical deep dive.